Hi guys, I'm going to go over exam 3 practice exam so then you can get prepared for the exam next week. All right, so the initial recorded cost of a plant asset should include both the cash and cash equivalent given up to acquire the asset and any costs for preparation for use. This is going to be true. Sol Company purchased a tractor at a cost of $120,000 as of January 1st, 2019. The tractor had an estimated salvage value of $20,000 and an estimated life of 8 years. If Sol uses a straight line method, what is the book value for 2023? So the straight line method is cost minus salvage value or residual value times 1 over the useful life. Or estimated life, either way. So to find this, you would take 120,000 minus 20,000. Then you can either just divide it by 8 or do times 1 over 8. But you'll get 12,500. So that's going to be for 2019, the depreciation expense amount. Then you're going to multiply that by 4 because to get it from 19 to 2023, that's 4 years. So that's going to give you 50,000. And now it's asking for the book value, not for the depreciation amount. So we're going to do the cost of 120,000 minus 50,000. And that's going to give us our answer of 70,000. So you got to be careful with what they're asking for. If they're asking for depreciation expense, it'd be the 50,000. What they're asking for the book value. So how is the gain or loss on a plant asset calculated? It's the sale price minus the book value of the asset. Franchises are considered to be an identifiable intangible asset and may be definite or indefinite. That's going to be true. It doesn't always have to be a certain way, it could be either. And at January 1st, 2019, the company had total assets of 5.4 million as of December 31st, 2019. The assets were 6.6 million. Their net sales for 2019 were 13,650, and the net income was 360,000. So what's our asset turnover ratio? The formula is net sales over average total assets. So that's going to be our net sales for here is 13,650. And then to find our average total assets, we'll take 5.4 mil plus 6.6 mil. And then divide by 2. And that's going to give us 6 million. You'll put 6 million down here, which gives us 2.275. Which of the following does not affect the current liability section of the balance sheet? That's going to be sale of goods on credit. That's not a current liability. All right, so then number 7. They issued a 60-day note in the amount of 540,000 on November 1st, 2019, an annual rate of 6%. What's the amount of interest accrued? So remember this formula, it's principal times rate times time. So the principal is 540,000 times the 6.6% rate, so 0.06. Sorry. And then times 2 over 12 for months. So it's November 1st to December 1st, December 1st to December 31st. That's where you get 2 months. And that's going to equal 5,400. Which of the following is not a contingent liability? This is going to be a discount on notes payable. A contingent liability is something that it's occurred by an entity depending on the outcome. So discount on notes payable doesn't have anything to do with an outcome, but like a lawsuit, you'd have to figure out what the outcome of that was with the outcome of the cleanup and credit. So what is the following is not a payroll tax on wages or salaries? So think of the homework that we did. We never used federal product excess tax. We used the other three though. So which of the following selections is not a component of paid-in capital? Retained earnings is not. So retained earnings is most similar to net income. So it's not paid-in capital. So during May 2019, Bryan Outdoor Corporation announced a 4-for-1 stock split. They brought the number of shares outstanding from 14,681 million shares to blank shares, and it's 5.4 par value to blank per share. So you're going to take this amount of shares times 4, which gives you 58,724,123. You're doubling the shares, but you're dividing the amount. So then you'll divide this by 4, which is 1.35. So it's going to be D. All right, so 12, which of the following rights do common shareholders typically not have? They don't have the right to receive dividends as a predetermined rate. They can elect the board of directions and deal with the assets and stock, but not the dividends. And then Belmont Inc. has outstanding 10,000 shares of 200 par value, 7% non-participating cumulative preferred stock, and 10,000 shares of 40 par value common stock. If the dividend on the preferred stock is 1 year in arrears, and the total cash dividend declared this year is $288,000, what is the amount to preferred and stockholders? So first, we're going to calculate this part. So 10,000 shares times the 200 par value times our percent non-cumulative, that gives us 140,000. So that's going to be at the preferred amount. Oh, sorry, it's cumulative non-participating. So that's our preferred amount. Now we also have 1 year in arrears, so that's that. And then we also need a current year. So our current year is also going to be 140,000, which is the same. You can use the same calculation because it's non-participating cumulative, so it's going to be the same. So then that total 140 plus 140 equals 280. And then our total cash dividends declared was 288. So subtract out 280 from that, which gives us 8,000 common. So this is amount in arrears. This is current, which gives us total preferred. And then that's the common, which is the difference. So it's going to be B. 14, which of the following is a cash equivalent for purposes of preparing a statement of cash flows, investment in money market funds? So if you think about it, like accounts receivable, common stock, and inventory, we use all of those in the statement of cash flows to go into the cash, but we don't use the money market fund. That's considered a cash equivalent. 15, cash paid as dividends to stockholders is classified as a cash flow from investing. Is that true or false? That's false. Dividends is going to be financing, not investing. A firm's net cash flow from operating activities includes our cash received from the sale of merchandise. That's the only operating. So equipment is investing, stock is financing, and loans is like a notes payable. So that's also financing. A firm cash flows from investing is cash flows from the sale of a plant asset. So that's most similar to equipment, like dividends, that's financing, received from revenues and services to customers, operating, bonds payable, financing. So 18, the excess of the sales price of treasury stock should be paid in capital from treasury stock. So that when it's in excess, paid in capital is always the difference. So that's how you know it's paid in capital for this one. All right, so now we are going to do some short answer questions. So Wild Bull Company purchased 400,000 for an estimated useful life of 4 years, or 660,000 cutting operations, after which the expected salvage value is 40,000. So we're going to need depreciation expense for 2019 and 2020. So straight line, like we did in the multiple choice, we take the cost minus our salvage value. And then divide by, oh, that made it weird. Let me just get rid of that. Oh, maybe it doesn't let me. Okay. So this, we could do it or times 1 divided by 4, or you could just divide it by 4 either way. Doesn't have to be 1/4. That's going to equal 90,000. Since it's straight line, that's going to be year 1 and year 2, both 90,000. For double declining balance for 2019, the formula for this first, I'll write it down, is cost minus accumulated depreciation times 2 over useful life. For 2019, the cost is 400,000 minus 0. Since it's year 1, we don't know what our accumulated depreciation is yet, times 2/4. That's going to give us 200,000. For 2020, we're going to take the 400,000, and now our accumulated depreciation amount is this 200,000 from up here. So minus 200,000 times 2 divided by 4, which equals 100,000. Units of production method, this is cost minus salvage value. I don't know why it's bold. We're just going to go with it. Times units produced during year divided by total units. So that is going to be for 2019, 400,000 minus 40,000 times 99,000. That's the amount for 2019. Divided by the total 660, which is found up here. So 660, that's going to equal 54,000 for 2020. 400,000 minus 40,000 is the same. Times, now it's 96,000. Divided by still the 660 for the total amount for the year, which equals 52,363. All right, so number 22. Now we're doing journal entries. So Aluminum Inc. engaged in the following transactions during its common stock for 2019. February 2nd, they issued 10,000 shares of 15 par value common stock at 90 cash per share. So we start with our cash is going to be debited because you're getting rid of your stock receiving money, which you take the 10,000 times the amount of cash, so 90. That gives you 900,000. You don't have to put the calculations in here on the exam. I just did it so that you can see. So now common stock is going to be the 10,000 shares times the 15 amount, which is the amount for shares. That's going to be credited 450,000. And then you're going to also credit your additional paid in capital, which is always the difference. So that's 750,000. For August 1st, they purchased back 3,000 shares of common stock at 93 cash per share. So when it says purchase back, you know it's going to be treasury stock and then cash. Oh. So that's just going to be the 3,000 times 93, which gives you 279. So September 1st, we're going to debit. So we sold 1,200 shares of treasury stock at 99 cash per share. So now we're reselling them. So we're going to receive money. And that's just the 1,200 times 99, which is 118,800. And now treasury stock. This one is going to be the 1,200 shares times your 93 cash, which comes from the August 1st date right here, which gives you 111,600. And then paid in capital for treasury stock is the difference of 7,200. Lastly, announced a 50-cent dividend payment on common shares. So the journal entry is going to be dividends and then dividends payable. So to find this, you're going to take the 10,000 shares that you have from up here. You are going to subtract out the 3,000 ones that were purchased back, get rid of them. Then you're going to add in the amount sold. That gives you 8,200. Then multiply it by the cash dividend of 0.5, and that gives you 4,100 as your number. All right, so you guys should be good with that one. And Fred Williams has the following income statement for 2019, gives you sales, cost of goods sold, depreciation expense, operating net income, accounts receivable, inventory, prepaid expenses, and accounts payable. So we're going to make the statement of cash flows for just for operating. So we're gonna, when it's using the indirect method, you're always gonna start with net income of 591. You're gonna add back depreciation expense, which is 135. And then we're gonna do our changes in current assets and current liabilities. So accounts receivable, that decreased from the beginning to the ending. So we're gonna put it in as positive. And then there was an inventory increase. So we're gonna flip the sign since it's a current asset. And it went from 120 to 129. So we're going to put it in as negative. So if you increase your inventory, you're decreasing your cash because you're paying for it. So our prepaid expenses decreased from 15,000 to 9,000. So we're going to add it back in. And then accounts payable decreased. So we're going to decrease it. So our net cash provided from operating activities is 741,000. So a good chart to use is going to be, I'll draw it out. So current assets, this is to help you for operating. Current liabilities. So if it increases, you're flipping the sign for current assets. So negative. So that's why we increased our inventory, but subtracted it out. But if it decreases, you're going to add it back in for current assets. So essentially current assets, remember to flip the sign. Current liabilities, if it increases, it's going to increase the current liability. So keep it as positive. If it decreases, it's going to decrease it. So essentially current liabilities stay the same, current assets, you flip the sign. All right, so on January 1st, 2016, issued 3-year bonds with a face value of 200,000, a stated interest rate of 8%. Because it's higher than the stated rate, the company receives 194,000 for the bond. The interest is paid semi-annually. So we're going to start with our cash amount, which they give us. That's the amount that they received, so the 194,000. And we also have down here, we have our bonds payable, which is always our face value. So that's 200,000. So see how we have a $6,000 decrease or discount to essentially get them to equal each other. So it's going to be a discount on bonds payable. And it's a debit, so then debits equal the credits. Now we have to do And this is going to be January. Now we need June 30th. So we're recording the interest payment. This is going to be a standard journal entry for interest. It's going to be interest expense. And we'll also need another discount on bonds payable and cash. So first, to find our cash amount, we're going to take our face value of the 200,000 times our stated interest rate of 8% times 6/12, because it said it's paid semi-annually, so two times in a year, half a year. So we're only finding for this first amount, so that's going to give us 8,000. That's our cash amount. And now we're going to find out our interest expense amount. So since we don't know our market rate, we're going to take the difference between our 200,000 minus our cash amount of 194,000, which gives us 6,000. And then since it's a 3-year bond, we have to divide that by 3. So that's going to give us 2,000. And then since it's paid, that gives us 2,000. Since it's paid semi-annually, we're going to multiply it by 6/12. That is going to give us 1,000. So that is our discount. So we can put that in here. To find our interest expense, we take the $1,000 discount plus our cash equals interest expense. 9,000. And then part C, it's just record the face value, which you guys don't have it on here, but that's just going to be bonds payable. When it says record the face value of the bond, just bonds payable for the face amount and then cash for the payment. All right. So that's it for this exam, at least for this review. I will send this to you guys. Let me know if you have any questions. You can email me. I just figured it'd be easier to just do online this time since it was kind of short notice with the review. So if you guys have any questions, you can email me. All right. Have a great rest of your day.